Welcome back to Freight Insight Weekly, brought to you by Freight Collab. We had a bit of a delay getting this episode out thanks to those UAE National Day holidays earlier this week.
Right.
But hey, we're back and ready to dive into a topic that's been making waves. China's economy.
Yeah.
It's complex.
Yeah.
It's impacting freight in a big way. And honestly, it's a must understand for anyone
Yeah.
in our industry these days.
I couldn't agree more. China's economic health is a bit like a giant engine, It drives global trade, and when it sputters, everyone feels the impact.
Exactly. And right now, that engine is facing some serious headwinds. We've all seen the headlines, right? A property sector meltdown, whispers of deflation. It can sound pretty dire.
Yeah.
But then just to throw us a curveball, there are signs of a manufacturing rebound.
Right.
It's a lot to process, to say the least.
Definitely. China's economic landscape is full of contradictions right now, and that's what makes it so fascinating and important to understand.
Okay, so let's unpack this, starting with the challenges. Reports in the Wall Street Journal and the Financial Times paint a somewhat concerning picture. One of the biggest issues is the property crisis.
Yeah.
With Evergrande struggles being just the tip of the iceberg.
Yeah.
Think about it. The property sector is a massive part of China's economy. When it falters, the ripples are felt everywhere, from construction materials to consumer spending.
It's not just about a few struggling companies. It's about the systemic risks that a property bubble poses, and that's where the issue of local government debt comes in. Some estimates suggest there's a staggering $800 billion in high-risk local government debt tied to land sales. When the property market cools down, those land sales dry up, leaving local governments in a precarious financial position.
$800 billion. That's a number that's hard to even grasp. But it gets worse. Apparently, youth unemployment in China has gotten so high that they've stopped publishing the data.
That's a significant red flag, and it speaks to a deeper issue. High youth unemployment is a sign of a struggling economy that isn't generating enough opportunities for its young people. It can lead to social unrest and hinder long-term economic growth.
Okay, so we got a shaky property market, a potential debt bomb, and a youth unemployment problem. And then, as if things weren't bad enough, there are worries about deflation. The Financial Times even compared the situation to Japan's lost decades to emphasize just how serious this could be.
The comparison to Japan is a stark reminder of the dangers of deflation. Deflation is not just about prices dropping. It's about a sustained decrease in prices across the economy, which can lead to a vicious cycle. Falling prices discourage people from spending because they think things will be cheaper tomorrow. This reduced demand further depresses prices, leading to a downward spiral. That's really hard to break out of.
So it's not just about prices falling. It's about what that signifies, about the overall health and confidence in the economy.
Exactly.
That's a really important distinction.
And for you, in the freight industry, this means operating in an environment of heightened uncertainty.
Right.
Are you factoring in potential disruptions to Chinese manufacturing? What about potential shipping delays due to port congestion? These are the kinds of questions you need to be asking as you plan your logistics and make decisions for your business.
That's a great point. This isn't just an abstract economic concept.
Yeah.
It has tangible consequences for how we operate in the freight world.
Exactly. Understanding the nuances of China's economic situation allows you to anticipate potential challenges and make informed decisions.
Okay, so we've established that China's economy is facing some pretty strong headwinds. But before we get too lost in the doom and gloom, there's another side to this story. A surprising glimmer of hope in the form of a manufacturing rebound.
Right.
More on that after a quick word from our sponsor.
Freight Collab. Don't forget to check out their YouTube channel for more insights and analysis on the world of global freight.
They've got some great content over there. Definitely worth subscribing. Hey, we're back with Freight Insight Weekly. All right, so before the break, we were painting a pretty bleak picture of China's economy.
Right.
But amidst all the talk of property bubbles and deflation, there's been some surprisingly positive news coming out of the manufacturing sector.
Yeah, it's been a pretty rapid shift. The Cason S&P Global Manufacturing Purchasing Managers Index, or PMI for those in the know, actually jumped to a 5-month high in November.
Hold on, 5-month high. That sounds like a pretty dramatic turnaround. What exactly is driving this sudden surge in manufacturing activity?
Well, the data tells an interesting story. New orders are up, and production is surging, particularly for investment and intermediate goods. This suggests that businesses are gearing up for something big, signaling a degree of confidence, or at least anticipation of future demand.
Investment and intermediate goods. So it's not just consumer products flying off the shelves. This sounds more like businesses are making investments for future growth. Does this mean China's economy might actually be turning a corner? Or could this just be a temporary blip on the radar?
That's the million-dollar question, isn't it? It's too early to say for sure if this is a sustainable recovery or just a short-term bounce. But what's fascinating here is how this manufacturing rebound ties into something we were discussing earlier. China's potential shift away from chasing high GDP growth at all costs.
You mean the article from the People's Daily?
Yeah.
Hinting that China might be okay with slightly lower GDP growth, even below 5%?
Exactly. If we connect this manufacturing data to that shift in thinking, it suggests that China may be moving towards a more sustainable, quality-driven economic model. They might be willing to sacrifice some short-term growth to address those underlying issues we talked about, like the property bubble and local government debt.
Okay, so maybe they're playing the long game here, focusing on restructuring their economy for long-term stability. That makes sense. But what does it all mean for our listeners, the people who are dealing with the day-to-day realities of global freight?
Well, that raises the question of how these internal shifts in China's economic policy actually translate into real-world impacts on global trade and logistics.
Because at the end of the day, that's what we're all here for. We need to understand how to navigate these complexities and make informed decisions for our businesses.
Absolutely. And this is where things get really interesting. On the one hand, the Financial Times reported that this manufacturing rebound has airlines scrambling to add capacity out of China. We're talking major players like Air France, KLM, Cathay Pacific, even DHL. They're all seeing the surge in demand and trying to keep up.
So for our listeners who are involved in e-commerce or retail, this could have a huge impact on your ability to get your goods moved during the upcoming peak season rush for Black Friday and Christmas.
Precisely. It's a perfect illustration of how something happening on the macroeconomic level, like a manufacturing rebound in China, can have a very real and immediate impact on your day-to-day operations in the freight world.
That's a critical insight. But hold on, there's another layer of complexity here, right? We can't forget about those ongoing trade tensions with the U.S.
Absolutely. The Financial Times also reported that Chinese exporters are rushing shipments to the U.S. to try and beat potential new tariffs that might be implemented under the new administration.
So it's like a double whammy. Increased demand from the manufacturing rebound and a potential surge in shipments due to trade tensions. What could this mean for U.S. port congestion? Could we see delays and even higher freight costs?
Those are some real risks to consider. This front-loading of shipments could lead to bottlenecks at U.S. ports, creating a cascade of disruptions that could impact shipping routes and schedules globally.
Wow. It's like a domino effect. So we've got a lot to keep an eye on here. We've gone from concerns about a Chinese economic slowdown to a sudden manufacturing surge, all while navigating the uncertainty of trade tensions.
It's definitely a dynamic situation, and one that highlights the interconnected nature of the global economy.
All right, so before we wrap up, I'd love to hear your final thoughts on this. Given this incredibly complex and ever-changing landscape, what's the one key takeaway you think our listeners should keep in mind as they make decisions in the coming weeks and months?
Well, I think the key takeaway here is adaptability. So
basically, expect the unexpected.
Exactly.
Be prepared to pivot quickly.
Yeah, and keep a close eye on developments in China.
Monitor those trade policies.
And build flexibility into your supply chains.
Don't be afraid to adjust those strategies as needed.
Precisely.
That's some really solid advice.
Thanks.
And thanks to you for joining us today and helping us break down this complex situation.
It's been my pleasure.
To all our listeners out there, thanks for tuning into another deep dive into the world of global freight.
We hope you found it insightful.
Don't forget to subscribe to the Freight Collab YouTube channel and join the conversation in the comments.
We'd love to hear your thoughts on this episode and any other topics you'd like us to cover.
Until next time, stay informed and stay agile.
And keep those freight moving.
That's a wrap on Freight Insight Weekly.